was an exciting weekend, but another exciting weekend is coming up on account of Independence Day. We'll have to see the kind of sales that these companies, these quick commerce companies, clock vis-a-vis e-commerce platforms. Meanwhile, ladies and gentlemen, amidst global tensions, ongoing global tensions, how are global investors looking at the Indian equities market? And from when can we expect FPI flows to bounce back, especially since valuations, they continue to remain a major concern? We have now with us Hemant Mishr. He's the co-founder and chief investment officer at S-Cube Capital, Singapore. Thank you very much, Hemant, for joining us here on ET Now. First things first, FPIs that were net buyers in Indian equities in the last quarter, they have turned net sellers of almost $4 billion so far in July and August. Now, with India's trade tensions with the United States at an all-time high since at least the end of the Cold War, do you see a surge of volatility in local shares in the coming months?
So thanks for the question. So we've seen quite a bit of volatility already, and I think the numbers are very important because you've seen an outflow of $4 billion, but this $4 billion is on the back of an $8 billion of inflow in the previous quarter. So in some ways, you've seen an exaggerated impact vis-a-vis on a Q-on-Q basis. Now, would this continue to be volatile? The unfortunate answer to that is yes. I think investors should be prepared to see increased day-to-day volatility, and it's for a triple whammy of factors. I think the first bit is the global environment continues to be risk off, given that decisions are getting made almost on a daily basis, getting announced through Twitter. And these are not just tariff-related decisions, but even geopolitical ones, which will have significant repercussion on investor appetite. The second one is specific to India. Clearly, investors have gotten rattled that India got singled out. And it's not the first baseline 25% tariff. I think the bigger hit is the incremental 25% on account of India buying Russian oil, where clearly India got singled out vis-a-vis China, who buys much more. So that, I think, in some ways has led to an increased volatility. But the third bit also is, India continues to be one of the more expensive markets, and I'll just draw a comparison with China, given where where global investors are. Chinese markets are now looking good. There's a lot of rotation and investors pouring money in out there, but it's still quoting at a forward earning of 11.8. vis-a-vis India quoting at 21. So I'm not surprised that you've seen a correction in Indian markets. And will this continue? It'll continue over the short term, but I think over the medium to long term, I do expect the incremental 25% on the Russian supplies to come off, given that we are factoring in a resolution to the Ukraine issue for the better over the next few weeks.
Right, sir. But would you say that this uncertain phase will be prolonged, and what impact you see about global confidence in Indian markets? You did speak about, of course, there's going to be some impact, but how prolonged it will be?
So there are 2 points there. I think the global markets continue to face a confidence crisis because people can't make long-term decisions anymore. I think old alliances are getting tested. Old trade partnerships are getting tested. So that, I think, will continue. Now, specific to India, I do expect things to improve. So the shock value of what we've already seen has already happened. But going ahead, as I mentioned, the Russia-related potential the Russia-related 25% incremental tariff that we've seen, which should potentially come off. So you might see a breather, but this could potentially take a few weeks before it actually gets better. Now, the one point I do want to make is, and I'm drawing a parallel with what happened in 1998 when we had US sanctions on the back of our Pokhran 2 blast. So the markets were jittery. We saw correction. In the equity markets, you saw correction in the rupee, which actually weakened. And you also saw a correction in the debt markets, where you saw a bit of a sell-off, by the way, which you're not seeing this time around. But it lasted all of 6 weeks. After 6 weeks, the equity markets were at an all-time high. So I don't expect this to be any different. On the contrary, it might be shorter than that.
Right, sir. And FPI investment, if we talk about that, that's remained largely resilient in Indian bonds so far this quarter. But what factors are essentially supporting offshore investments in local debt? And are foreigners comfortable with India's current macros?
Again, that's a good question, and that's a really bright spot, because while there's negativity on India because of the tariff-related situation, it's not seen in the debt instruments, and we expect to see that on a continued basis. And it's driven for two reasons. One is India's macro stability from a fiscal point of view, also from a current account point of view. So our fiscal deficit is gradually coming down. In fact, there's a strong case for India to be re-rated. And our current account deficit numbers look pretty good. We're expecting it to be less than 1%. And obviously the FX reserve situation, which is nudging $700 billion, looks very, very good. But when I look at it from an investor's point of view, the real rates that we get in India are one of the highest. The 10-year bond quotes at 6.5% in rupee terms. RBI's estimate on inflation is around 3%. So you're getting a 350 basis point real rate. Compare that to the US. The 10-year bond is at 4.2, inflation around 3%. You're getting 120 basis point. So I think that's a damn squib. I think anybody who wants to kind of invest in a long-term structural kind of manner would invest in India. So I do expect this to be on a sustained uptrend, and global investors continue to invest till the cap that they can.
Mr. Mishra, as you talk about that, let me also ask you about how do offshore equity investors essentially view the slowdown in corporate earnings in the first half of FY26? And is that a signal of another bout of an impending correction in local equities?
So that is a concern and remains to be a risk. Honestly, we ourselves were disappointed at the single-digit EPS growth that we've seen. And while it's localized, largely out of the IT sector and also on account of consumer discretionary spend coming off, particularly in rural India. But we'd like to believe it's a localized problem. Our estimates for the broader economy continues to be a 10 to 12% EPS growth. If it continues to track that, I think that should provide downside protection to any more sell-off. But in the event that it doesn't, and it's for the reason that I mentioned, because the valuations even at these levels continue to be high. So if the EPS story hasn't got stronger legs, and if it's more single digit than actually a 12% EPS handle, then you potentially are looking at a value-driven correction. But at this point in time, I think people are not looking at this as a structural re-rating.
All right, Mr. Mishra, thank you very much for taking the time out and putting into perspective all that's been happening so far as FPI trends are concerned. Definitely, India's bond markets are a bright spot for foreign investors. However, there is significant de-dollarization as well. That's a trend that's seen globally. Ladies and gentlemen, that was, of course, Mr. Hemant Mishra from SQ throwing and, in fact, showing a spotlight on FPI movement and, of course, on certain global trends with respect to Donald Trump's tariff policies.